This data point does not get covered by Wall Street, doesn't get covered by major media, the CNNs of the world, but the average annual gold price has advanced 84% of the time this century. So gold is trading at all-time new highs. And that a lot started with Trump's Valentine's Day, the tariffs massacre, when he first launched his big attack. And then on April the 1st, he had what's called Liberation Day. This quarter end, March of 2025, will post record revenue, earnings, and cash flow growth in these gold stocks. And they trade at PE ratios. Basically, a lot of them are half of what the S&P 500 is, with much stronger revenue growth and cash flow. So I think we're in a real gold stock bull market. Well, I think this is my most important disclaimer for everyone, and this is to understand the DNA of volatility. Every asset class has its own unique DNA of volatility, and it changes over time. So we update this every quarter. And reason for that is that if we go before 2008, the financial crisis, gold was trading at 2 to 3% in a daily basis, the volatility. And it's really toned down as more institutions and more central bank continue to buy gold, which I think is really quite fascinating. And the 10-day volatility of gold used to be what Bitcoin is today. It used to be 8%, and now it's a non-event. And this means that 70% of the time for the stock market or gold to go up or down 1%, but it has a significant impact on Bitcoin is 3 times that daily. And the 10-day for gold and the S&P 500 is 3%. It's very similar when I look at the DAX market or I look at the UK market. They're very similar to the S&P, and I believe that's because of all the index investing and all the pension fund consultants that turn around and they only buy indexes, so it ends up lowering the volatility. But what's really interesting is that volatility has become the new Viagra, as the traders tell me in New York, because volatility, like strategy has, MicroStrategy, is 6% a day. And that's what investors want, but they're really much more about speculators of what they're doing to play Bitcoin the way Michael Saylor's doing strategy. So it's recognizing those differences in volatility. Hive has a high volatility. And I want to thank everyone that's been a very patient investor in Hive, like I have been. And it's been really frustrating seeing in the US all these convertible bond issues they keep floating, these other crypto mining companies. And Hive has been pressured and shorted as a proxy for these converts by these hedge funds. But we're not doing them. And they've been doing them to buy more Bitcoin. And the numbers are so great when you have a market cap of an industry of 25 billion and $5 billion is announced over 10 days of new converts. They short everyone in the industry because the daily volume of trading Bitcoin mining stocks is only a little over $1 billion. So you're seeing that these things have been suppressed. But underneath the hood is most important to look at, and hopefully you'll understand why I'm so bullish on the story of Hive and Bitcoin and gold as we go forward. But remember, you have to understand the DNA of volatility. It's probably best to buy when things are down twice what the daily standard deviation is. So if you see Bitcoin down 6% a day, it's usually a good buy. Thank you. Next, please. So recently, I was in Paris, and this is a photograph from speaking in Paris, which really blew me away because I didn't know more than 50% of the companies were up on the wall. And they had 9,000, John. They had 9,500 people spending $1,000 a ticket to attend that blockchain week in Paris. And they held it at the Louvre. They had a special showing for the Mona Lisa. It's another level that you just don't see in gold stock world, or you see even institutional investors at BMO event in Fort Lauderdale, or the Denver Gold Show. You just don't see it, and it functions outside of our world. And this, I'm going to weave this back into Hive and Bitcoin, but it's important to recognize that these two industries now are much more coming together, mainly because of President Trump's bullish positioning on Bitcoin. And I'll try to explain that as we go through the presentation. Next, please. I love this. I love because I've always given money for education. I've been very blessed to grow up in inner city Toronto, but have great parenting and great education, and went to the second oldest college that founded the second biggest university in Canada, called Western University, which is the premier business school. So this is the biggest feeder into it, and it's a beautiful building for the students. And has a curriculum for leadership, ethics, and entrepreneurship. Next, please. Why gold? Well, it's an inflation hedge, but in the young millennial investor and generations X, Y, and Zs, it's portable wealth. That's the way they look at it. And if you look at gold with the fear trade, and you see that people used to wear gold bangles in Syria, the ones that got out first were able to take off their gold bangles to get out. If you go back in time to the 70s, the boat people from Vietnam, they were able to, that had 24 karat grams of gold, called a gold tail. This was their exit out. So it was portable wealth because the paper money in those countries became worthless. In a civilized world, like in a structured world, and in democracies like we live in Germany and in the US and Canada, it's an inflation hedge against all the government money printing. It's also important in diversification of a portfolio. I've always articulated the 10% golden rule, that you should have a minimum of 10% in gold and gold equities in a portfolio, and to rebalance every year. And I'm going to walk you through later on why that's worked this century. It's a safe haven asset when you have a new president like Trump and having a tariff war, which is like shifting tectonic plate shifts all around the world. What it does to currencies and the volatility, all of a sudden gold becomes a safe haven asset. And we have something else that's unique is the central bank gold demand. It continues to grow for several reasons. And so what's happening is that gold is now looking like a Bitcoin asset as an alternative asset that's not controlled by any one government, with growth potential. And that's what excites speculators, where you have that element of growth. Next, please. So government policies, we write about this, we put it in all of our prospectuses and our funds, that we believe at US Global that government policies are a precursor to change. And so we monitor and track the G20 countries, and we look at the balance and the imbalances between their monetary and fiscal policies. Now, we all know the internet is a binomial model that is made of zeros and ones. But what's interesting is that you can take government policies and break them down to zeros and ones, monetary and fiscal. And then monetary is interest rates, in particular real, and money supply. Fiscal is tax and regulation, or now the buzzword is tariffs, and spending. And whenever you get a big imbalance between the fiscal and monetary policies, gold shines in that country's currency. That is the fear trade. And that is about 40% of the demand for gold is out of fear. The other part is love. 60% of gold demand is love. And a lot of that has to do with China and India and Southeast Asia and the Middle East, where gold is given as a gift for anniversaries, for birthdays, for the zodiac in Asia, the 12-year zodiac, the year of the goat, year of the tiger. You can see if you go to Hong Kong that the 24 karat gold, the tigers were there last year. You can see it's really interesting each year as this changes. So I believe that it's important to look for this imbalance. And the biggest imbalance we've had this century is called modern monetary theory. the practice of modern monetary theory to print money to be able to drive an economy. And the more as countries have used this, and the greater the percentage of their overall government policies to use it, the greater gold is performed. And this really shocks a lot of people when I go through these next slides to show you how well gold is performed. Next, please. But before we get into more micro, let's talk about what I like to call cause, effect, and possible ramifications. Newton's law of looking at cause, effect, and possible ramifications, negative real interest rates. It impacts inflation, monetary policy, you get increasing gold demand. Surging interest rates create banking instability. Gold is a currency. Central bank buying. Gold as a currency has become a very dominant force. And force in laws of physics is force equals mass times acceleration. And as you get more and more of the G20 countries accelerating and buying gold, which is limited in supply each year, then you get gold going through this bull cycle. And there's a reason for that, as central banks are seeing more and more of MMT being used and being abused. Lack of new mine discoveries reduces supply. That's a fiscal policy. China's Xi Jinping's dictatorship is de-dollarization, mobilizing the BRIC nations to attack the dollar, creates more gold buying. And that also triggers up to number 3, central banks buying. And then we have U.S. government aggressive foreign policies. An alternative global currency is bullish for gold. And Trump's tariff war creates a currency reset and a possible recession. That's bullish for gold. So we have many factors that are creating turbulence in the global equal trade system, and gold is shining because of that. Next, please. This is a simple, and gold became basically the ability to convert a US dollar into gold, and that gold window was closed. Gold has basically gone up over 100-fold. And it's interesting to see that it's I think it should be actually trading higher. That's one another reason why I think it goes to 4,000 this year and 6,000 by the end of Trump's term as president. But it's interesting to see that gold is portable wealth, and it is important for many emerging countries in particular, and the rise of luxury goods. You can see the use of gold is actually increasing. Next, please. So gold price has outperformed the market so far this year. It's ahead of the S&P 500. But what's more important is what has it done this century, and gold has outperformed the S&P this century. And it's really, I think, important for investors to recognize that, okay, well, has it all happened in one quarter? Is it because of Trump? No, it's not. It's been happening, in my thoughts, because of MMT has created this imbalance, and the rise and the significance of GDP per growth of China and India, who collectively are 40% of the world's population and who have a cultural affinity for gold. That demand is an underlying bid every time gold is sold off. So that's the love trade. And I believe it's not gone away, and it's not going away. If anything, it will only continue to rise. Next, please. This data point does not get covered by Wall Street, doesn't get covered by major media, the CNNs of the world, but the average annual gold price has advanced 84% of the time this century. You just don't believe that. It's hard to fathom what an incredible asset class this has been. So having 10% weighting and rebalancing each year has really helped the diversified portfolio. Next, please. So gold has the second highest trading volume in 2024. What's important is the futures market impacts gold. The gold ETFs also impact the overall liquidity and trading that takes place. I think that more than 50% of the stock market now, as you can see, the S&P trades more than gold. And a big part of that trading has to deal around with ETFs and shorting and going long in various trades create more and more liquidity. And you're seeing that some of these big public companies like Barrick is leaving Toronto to move to the US so that they would qualify to go into the S&P 500, and that could add on 50% to their stock price, is what some people believe. And that it's just so big, and there's so many pension funds and institutions that use the S&P 500 as a proxy. And I think that that's an interesting move, because last year we had Palantir move from the New York Stock Exchange into NASDAQ to qualify for what's called the QQQ, and that popped its stock by 80%. But interesting enough, in this whole spectrum, if you stay here, is that Bitcoin is number 4 in trading volume. Remember, Bitcoin does not have a CEO. It does not have any central government controlling its adoption process. And it only became an asset in 2009, just before President Obama became president. It's really an incredible asset class that it's surpassed US corporate bond trading, German bond trading, and British bond trading, the world of gold. And it's something that's happening outside, and I believe that it will shortly pass the Dow Jones and the Euro Yen and the Euro Sterling as it climbs in overall valuation. Next, please. So gold has historically tracked money supply growth. And money supply growth, there's a lot done in the Bitcoin ecosystem of how many weeks, and it's usually something like 8 weeks that they talk about Bitcoin. But the gold is slower. It's slower to move. It's just what it is. It's has a much longer centuries of stability as a monetary asset, a portable, decentralized asset. So gold is trading at all-time new highs. And that a lot started with Trump's Valentine's Day, the tariffs massacre, when he first launched his big attack. And then on April the 1st, he had what's called Liberation Day. And it's very complex. It's another whole presentation to talk about tariffs. The tariff war can have a much more significant impact on Germany and China than America. And the big reason for that is because the GDP in Germany relies on 40% of exports. In China, it's over 20%. In America, it's like 10%. So it's recognizing what he's trying to do is to create a greater equality. But I think a lot of the German car manufacturers are already over in America. I think the real burden on the car industry is going to be Toyota in Japan and Korea, unless they drop their tariffs to make it easier so that there's no tariffs. I think that's really what the push is. But until all that happens, we have, and if you've not read the Art of the Deal, and go to Grok, the AI service on X, or go to OpenChatGPT and ask for the 10 take-home value metrics from the Art of the Deal written by Donald Trump, and you can understand this is all part of his strategy of getting the world to wake up, just like he's done with NATO spending. And then all of a sudden, military spending in Europe is taken off. I see that Sweden now is up 9% year over year. And German manufacturers for tanks and ships, et cetera, it's been on a torque, and they've been just great stock performers. So the tariff war is also really benefiting military stocks out of Germany. And I think it's also benefited gold. It's interesting to watch the fear trade, how it's implemented and how it's executed. Next, please. So holding physical gold ETFs are increasing. And this to me was really an important part of looking at data. If we go back roughly a year ago, there was roughly 81 million ounces of gold in all these ETFs, bullion ETFs. And it peaked at 94 million. Even though gold has been rising, there has been redemptions out of the gold ETFs, both bullion and stocks. Talking to Van Eck, they told me they lost $2 billion last year because a lot of hedge funds were short various names and they went long their ETF as they were covering their gold stocks. Not being short, they redeemed out of their ETF. So we know this from our other ETFs, like the Jets ETF. We get this flow where people are short various airlines and long jets as a pairs trade. This is happening in gold stocks. But what's really important for you, the listener, on this particular presentation is that it didn't take much. It took about $6 million, and gold went through a spectacular move of $1,000. And so just think of what would happen if another 6 million ounces of gold bullion came in buying. That gold would easily be $4,500 an ounce or higher. And so it tells me that a lot of the finger traders, short-term traders in gold, they're gone. We're seeing hedge funds all of a sudden taking a bigger position in gold. We're seeing central banks continue to buy gold. They're not buying the ETFs, but they're buying derivatives, and they're all interrelated, which is important. So when the data comes out that Poland bought more gold, all of a sudden investors will go all of a sudden buy the bullion ETF. There's a influence factor of central bank buying. But important here is that Trump's Valentine's Day's tariffs ignited demand for gold. Next, please. Gold mining stocks outpacing physical gold in the market. Yes, that's true. We finally had that we're starting to get some move in the gold stocks. They've been deeply lagging. And now they're starting to really put on the torque. If you look at year to date, they've far outperformed, especially the South African marginal gold producers. They have this quarter end, March of 2025, will post record revenue, earnings, and cash flow growth in these gold stocks. And they trade at PE ratios. Basically, a lot of them are half of what the S&P 500 is, with much stronger revenue growth and cash flow. So I think we're in a real gold stock bull market. Next, please. So a lot of people say, well, look at this moving gold, and it's at a 30-year high. It's come back. Are we overvalued? And I'm going to share with you we're undervalued, because stocks have come back to when gold was 1,500, not 3,500. And the cost for mining today might be 1,500. So they're actually making much more profit margin today. And you're seeing something else that's really important. Newmont's recent press release, they're not buying mid caps and junior gold producers yet. That's not happening. They're buying back their stock. They're not buying bullion, which really surprised me that they should be buying gold because it's so cheap. No, they're buying back their stock with their free cash flow. Or you're seeing other companies pay down $1 billion of debt from expansions they started 5 years ago. Now they've got this big free cash flow. So the capital markets, the mining companies are much more disciplined about the cash flow return on invested capital. So I think they trade higher. Next, please. If we're looking at undervalued relative to the S&P, they're deeply undervalued. That's basically taking the ARCA index and dividing the S&P, and you can see the real bang for your buck is buying these gold stocks. Next, please. This hasn't happened since 2003, and I follow IBD, Investors Business Daily, because I think it's the best stock selection for growth stocks in America for following hot new products. Starbucks came out very early, back like 2003, and showing up in IBD as they had this rapid expansion growth. But back in 2003, we had several of the gold stocks were making growth. So they have to show growth in revenue year over year, quarter over quarter. They have to show earnings growth year over year and momentum in their stock price. So this is very important because out of the 50 stocks they track every week that meets their model, more than 20% are gold mining companies. This is the first time since 2003. And some of these companies, we were seed investors at US Global, Wheaton Precious, we were a seed investor. You can see Triple Flags, it's a new gold royalty company. Royal Gold is there. Cisco Gold Royalties is there. Newmont is in there. All these stocks are on a tear, and some of them are outperforming others. In particular, the marginal gold producer, that is, they have a higher cost. So as the price of gold is rising, their profit margins are expanding, like Harmony. So it really is much more volatile. The volatility of Harmony is almost twice what Newmont is. And it's just to recognize those differences, but they are showing up in the IBD as growth technology stocks. Next, please. So one of the things that's really happened in the geopolitical landscape, and one of the big threats for President Trump that's been a great concern, especially the guy on the far left here, Xi Jinping. And since he became the Mao of China, the dictator forever, he has significantly increased military spending, much more than what the US or NATO spending. NATO countries, and in particular America, spend 50% of their budgets on salaries and healthcare benefits for the soldiers, past and new soldiers. China does not spend, and neither does Russia spend even close to that amount on the cost of a soldier. So they've been spending much more on weapons. And so not only have they been spending on weapons, they've been buying gold because, in particular, Saudi Arabia told them that their currency is not fungible, so that they would, if they want them to convert, for them to take yuan for their oil, then they would have to have more gold as a backup behind their currency. And so we're seeing these other countries making sure that they have a strong gold position and gold production in their countries, because they're trying to de-dollarize. I don't think it's going to happen. What's interesting, who's been hurt the most has been the euro, because as soon as Saudi Arabia gets that yuan, they convert it to dollars or to euros, but predominantly dollars for global trade. So you've seen a bifurcation where the dollars has grown as overall trading as a currency more than the euro. But this attack, be it military spending to have icebreakers. Why does China need icebreakers? Why does Russia need 45 icebreakers? Because they're trying to make claim to the Arctic Sea and make claim to Greenland. And that's why you see Trump talking about Greenland. It's all about the protecting of what Russia and China want for as a trade route, but they've been trying to buy old military bases from World War II that were built in Greenland, that America built, that they've been trying to buy them. This is before Trump came into power, and they've been shut down. They're trying to start up strategic minerals development in Greenland, and they've been shut down. So Canadian gold producers and explorers have also been strategic mineral explorers, have been investing in Greenland, and we have been investing for more than 3 decades. With early explorers going to Greenland. So I think it's really heating up about the potential of Greenland, but it's more geopolitics, like the BRICS nations trying to de-dollarize gold, the US dollar, and that just means more central banks are buying gold. That's very bullish. Next, please. So in 2020, I said gold could reach $4,000 over the next 3 years, and we're getting there. It's a little lagging. It's now 5 years since 2020. We have other events that come along unexpected, but I still hold that I think 4,000. And when I look at money supply aggregates and I compare it back in 2019 to today, I think $6,000 is very much in the cards. Next, please. So we have three favorite royalty companies: Franco-Nevada, Wheaton Precious, and Royal Gold. Why? Because of rigorous smart beta 2.0 backtesting. We use computers that we can't do quant trading. And for the user listening, quant trading usually has a 3-day max horizon, 3 minutes to 3 days. That is, they trade off a sentiment. They do not take long-term positions. So we said, well, how do we turn around to make something that's quarterly off the earnings results and balance sheet and income statement results that come out every quarter? Is there factors that we could use that we could actually pick stocks better? And one of the big parts was the gold royalty model is just a superior model. So now we've seen many junior mining companies raise money by becoming a royalty company. Several of them now have been taken over. And it's, to me, it's just one of those great like technology models called a SaaS model, that when Microsoft went to a SaaS model, they went from 40 billion to 150 billion cash on their balance sheet. So it is a wonderful, sweet model. Next, please. So our quant factors for selecting gold stocks and recalibrating every quarter are profit margins, cash flow per share growth, revenue per share growth, free cash flow yield. The higher the free cash flow yield means the greater the deep value. Usually they're the ones that get taken over. And EBITDAs to enterprise value is another deep value approach to looking at gold stocks. And cash flow return on invested capital really reflects the smartest management teams and boards of directors. Next, please. So the two can be inclusive. What do I mean when I say that? That is, I believe that Bitcoin and gold are inclusive as alternative assets in a diversified portfolio. And having a minimum of 10% in gold and 2 to 5% in Bitcoin or Bitcoin mining companies is just prudent in this economic world that we live in. Next, please. So Bitcoin and gold, their roles: gold is a symbol of wealth and power. Bitcoin is digital gold with scarcity, greater scarcity. Gold standard supported by monetary stability, but Bitcoin offers portability and divisibility. That is, one Bitcoin is worth 100 million Satoshis. And if you go to, in the US, and go to Robinhood to buy $1,000 worth of Bitcoin, which you can, one of these ETFs, you're really buying Satoshis. And when you spend $1,000 today buying HODL, H-O-D-L, VanEck Bitcoin ETF, you're buying about 1 million Satoshis. That is 0.0006 cents you're paying. And I know from what I've seen that is pretty foreseeable to see at 1 penny, a Satoshi makes Bitcoin worth $1 million. And by adoption, there's a mathematical law called Metcalfe's law, and it really is pretty powerful in suggesting why Bitcoin will trade higher. But it doesn't mean that Bitcoin is better. It means that Bitcoin is an alternative asset class that's important for diversification. Next, please. But because its volatility has a lower rating. So gold and Bitcoin, two halves of the same coin: portable wealth, inflation hedges, global accessibility, independence from centralized central banks and governments, and speculative opportunities. Next, please. The difference between gold and Bitcoin: gold is basically characterized as a commodity. Bitcoin is a commodity. Supply is unknown, but it's very, very difficult and expensive to explore and develop a gold mine. I remember the life cycle of a mine used to be 7 years when I started this business in 1978, before many of you were born. And I laugh because it was only 7 years and now it's 30 years. So that supply is really restricted, and you're getting about 110 million ounces of supply a year, of which a good portion is also recycled gold. But from the gold mines, there's no big rapid increase that's taking place unless they're acquiring somebody else. But Bitcoin is capped at 21 million coins, and that's a scarcity element. And because of that, it's grown faster. But I also, when I spoke at Paris Blockchain Week, I highlighted that a lot of the Bitcoiners came from gamers and coders and gamers from 2003 to 2015. They're in that whole run there. Young men now are millennials, and they're paying taxes. They've got jobs, but they were gamers at one time, and they were mining, and some of those games gave them digital money. So the adoption of Bitcoin is predominantly from that generation at this stage. But that generation is going to inherit all the baby boomers my age wealth. So I think the Bitcoin growth paradigm is quite easy to forecast, especially if you're a younger speculator investor. History, new technology. The other one is reliable over history for centuries. It's also beautiful. And you got to remember that there's a lot of investors that want to see and feel their wealth. So when they wear gold, a gold ring, they can feel their wealth. When they drive a Lamborghini, they feel and see their wealth. When they drive a beautiful new Porsche, they see and drive their wealth. There is a group in society out of 8 billion people that feel safer and more comfortable when they can see and feel their wealth, and gold will always appeal to them. It's just recognizing that. Whereas you have Bitcoin is for the virtual world, whereas gold is for the real world. Bitcoin is more like modern surreal art, and gold is the classics, Renaissance, Mona Lisa, Renaissance paintings. So regulations will grow, but the most important part is what's happened with President Trump, learning and embracing Bitcoin as private property rights. That's the real key factor, and that's what's important part about gold. It's portable private property rights. Next, please. Well, not all miners hodl their metals, and Hive is Bitcoin. We hodl as much as possible, unless we have to go and expand our operations. Then we would use some of our Bitcoin. And we've done that in the past, and we'll do it in the future as long as we know that we have wind at the sail to replace it from expanding Bitcoin operations. Next, please.